Hi, everyone. My name is Megan O'Rourke, and I'm the Associate Director of Regional Programs for the University of San Diego Alumni Association. We're happy to have you for today's New York Torero Club event, Investing in Today's Volatile Market. Before I launch into today's session, I want to extend hopes and prayers from all of your friends at USD that you and your loved ones are safe, healthy, and doing well despite the challenges we've all been facing these past couple of months. These are without a doubt some of the most challenging times we have faced as a country and as a community. So please know that your friends at USD are thinking about you and praying for you and your loved ones. During this time, the Alumni Association staff is continuing our efforts to keep alumni engaged with and connected to the university. Now that we are virtual, we have pivoted to offering programs that are of the greatest need of our alumni. We understand that many of our Torero alumni are continuing to look for ways to educate themselves on investing, especially during times when the market is volatile. To help us better understand the market, the New York Torero Club introduces you to New York Torero Club committee member Erik Carter, class of 2009 JD, USD alumnus, lawyer, and financial wellness coach. Erik will discuss key mistakes most investors make in a volatile market, what to look for when choosing investments, and how to make volatility work for you. In addition to our live audience, we are recording this for a later viewing. For those who have joined us live, kindly mute your mics and turn off your camera if they aren't already. We ask that everyone keep their mics muted and their cameras turned off during the remainder of the event. Should you have any specific questions for Erik throughout the event, please put them in the chat and we will address them during the Q&A portion of the event towards the end of today's session if there's time permitting. Alrighty, well, let's get started. Erik graduated from the USD School of Law in 2009. A self-described lifelong financial nerd, Erik Carter first started learning about investing when his father gave him the Dean Witter Guide to Personal Investing in 4th grade. He then studied economics and began his financial planning career right after college during the 2000 dot-com crash. He has since provided financial guidance to some of the most successful people in politics, modeling, business, and professional sports as a financial advisor, and then transitioned into a financial wellness coach. He also writes regularly for Forbes.com and has provided commentary on numerous media outlets, including CBS News, Fox Business, and CNBC. Erik, thank you so much for taking the time to visit with us today.
Great. Well, thanks for having me, and thanks to everyone for coming.
Absolutely. All right, you can go ahead and take it away.
Awesome. Well, thank you everyone for coming here today. This is an interesting time to talk about investing because, this is a kind of a talk that I've been doing pretty consistently over the last 10 years. And I think it's particularly applicable right now of how to deal with a volatile market, to say the least, right? I mean, you think about this year, we've definitely had a lot of ups and downs, and people are really, concerned and worried about what's going to happen between the pandemic and the election and, all the debt that the government has been accruing, and what is this going to mean, for you and your investments, and especially for someone maybe just getting started that has never experienced something like this. And as you heard, with my little bio there, I actually got started in the financial world in 2000 during the dot-com crash. So I was fresh out of college, starting as a financial advisor. And so I started off in a really bad market and then went through the 2008 financial crisis. And then now with what's going on through COVID. So what I'm going to do is share with you some of the things that we've seen both in academic studies and also how it applies to real world people and how they can, avoid mistakes that I see people making and actually how to make market volatility work for you. And then we're going to open it up for a lot of Q&A time, because that's really, to me, the heart of this. But just to start, I think this is an interesting place to begin with, and that is what you really don't want to do, which is be the average investor. So if you look at this time period, about 20 years, 1999, so this is just before I started my financial career, until this particular study happened to end with 2018, a couple of years ago, the average investor actually earned less than almost anything they could have invested in, which blows your mind if you think about it, right? You'd expect it would be kind of an average or in the middle somewhere of all these different types of investments. It doesn't even make sense mathematically why the average investor would do worse than almost anything they're investing in, and even worse than inflation. And the reason this is really important is because when people are making retirement projections and other things, they're assuming a rate of return that's much higher than the average investor is actually earning. Now, by the way, don't get too distracted by the fact that REITs, which are real estate investment trusts, were the top performer over that 20-year period, because when you look at different 20-year periods, different investments do best over different 20-year periods. So it's not that real estate is always going to be the top performer, but the average investor underperforming is pretty common. And the reason we see this is how human nature tends to react to this cycle. And there's a lot of different things that can cause this cycle. It's always different. You know, again, I remember when I first started, it was the dot-com bubble, and then we had the accounting scandals, and then, well, but actually before that, there was 9/11. The accounting scandals happened. We had the financial crisis. There's all different types of things that happen, and every time it feels unique, but in a way it's not, right? And because the common pattern we see is that for various reasons, there are times when the stock market's doing really well. And when it's doing really well, we look at our statements and we see that we're making a lot of money and everyone around us is doing well. And there is a tendency to get a little greedy, for lack of a better word, right? We want to be able to do better. And so if we have this, you know, diversified portfolio, all of a sudden it's not doing as well as whatever is hot. And the tendency is to want to put more money into whatever has been doing well. Look at the last few years, it's the big tech stocks that have been making all the money in the market. And so if you didn't have your money in the tech stocks, you know, you weren't doing well. If you had all your money there, you're doing great. The problem is nothing lasts forever. And at some point, no matter what investment you're talking about, whether it's real estate or stocks or gold or bonds or different sectors, eventually these things come crashing back down. And when they do, people tend to first hold on a bit because you're waiting for it to turn around, and then only when things get really bad is when people tend to want to get out. You know, they say they want to stop the bleeding, and that's when fear kicks in. Now, the thing about investing is you want to make it as unemotional as possible, because when we're following our emotions, we're either being a pig and being greedy and wanting to get those really high returns, or being a chicken, right? We're afraid of the losses. And the thing that pigs and chickens have in common is they can both be slaughtered. You do not want to follow that pattern, which causes people to buy high, right, when things are doing well, and to sell when things are not doing so well. So what do you want to do, right? If the idea is we don't want to be chasing past performance, and I can tell you, you know, if we had more time, I could go into a lot of statistics about how difficult it is to predict what the next big thing is going to be. And the way I always put it is, if someone could consistently predict that, whoever that person is would be running the most successful mutual fund or hedge fund out there, and we'd all know who they are. And the reality is there's nobody out there that's built an amazing track record by making those accurate predictions consistently over time. You know, every once in a while, people get it right, but more often than not, they get it wrong. And the future is very hard to predict. So just like we don't want to react to the past, what's happened before, it's very hard to predict the future. And that's where this idea of diversification comes in, or the fancy term for it is asset allocation. That's how do we figure out, right, how to spread our money between these basic type of investments, right? Stocks, bonds, and cash. And a bit later, I'm also going to show you how you can make this really simple. But I'm going to show you a little bit of how it works, and then how you can apply this yourself in a way that it makes it really, really easy. But first, just to kind of, you know, review the differences here, the main difference between cash, bonds, and stocks is the level of risk that you're taking with these. So when you think of cash, think of money in the bank, right? Just earns interest. So we're not just talking about literally physical cash. We're just talking about money that investments that don't really go up and down, right? At most, they may earn a percentage or so of interest right now. With bonds, what you're doing is you're basically loaning money to a government or a corporation that's looking to borrow money. And so you're collecting a higher interest rate typically than you are with cash, but those bond prices can go up and down. So there is some risk involved with bonds. And then with stocks, you're becoming an owner of a company. And so in the long run, you have much higher potential return. And historically, we've seen much higher gains in the stock market, but that comes with a lot more risk, okay, a lot more volatility, as of course, as we've all seen this year. So how do we figure out how to get that right mix? Well, it all begins with your goals. I always like to think about investing as really a way to get from point A to point B. What are you trying to achieve with your money? So if you're setting aside money to buy a home in the next few years, you want to invest that money really differently than if you're planning to retire in, say, 20 or 30 years from now. And the main difference there is going to be your time frame. And the reason time frame is so important is because when you look at stocks, which again, in the long run, tend to have the highest return, in the short term, they are really volatile. So this shows you between stocks, bonds, and then a mix of 50-50, that's what that gray is, kind of the best and the worst over different time periods, right? So you look at that 1 year time, and the worst from 1950 to 2018 was a loss of 39%, almost 40%. That's the 2008 financial crisis right there. But look at the big gain. The best was 47%, almost a 50% increase. But as the time frame gets longer, as we go out to 10 years, the worst stocks did was about 1%, or actually negative 1%, in the absolute worst 10-year time period per year, until you get to 20 years. And the really cool thing about 20 years is if you look at the stock market over that time, the worst 20-year period was a 6% per year average return, which is pretty good if you think about it. And that was the absolute worst. Now, that doesn't mean that we can't have a 20-year period going forward that's going to be even worse than anything we've seen before. But at least historically, that's the worst you've ever seen. And of course, the best was that nice 17% return. And so the lesson that we get from this is when you need money in the short term. So anything in the next 5 years, I know 5 years may seem like a long time from now, but when it comes to investing, that's a really short time frame. That's not money you want to put in the stock market. So if you're planning to buy a home in the next few years, or money you set aside for emergencies, you want to keep that money in cash. That's what cash is for. That's money you want to keep in the bank. Okay. Don't want to put that money at risk because you could see a significant decline and it could take years to get your money back. On the other hand, if you have a long time until you need that money, let's say it's 20 years or more, that's when you can afford to be more aggressive with your money and have it more in stocks. Because as we saw, even the worst case in the long run in the stock market is not so bad. So that's the first thing to really think about is what is the time frame for you to need this money. But the other aspect is your personal comfort. Because there are people, and you might be one of them, who can't sleep well at night, right? When you see the value of your money, the value of your portfolio fall, like it did earlier this year. And that's okay. What that means is you may naturally be a little bit more conservative, and you may want to have a little less in stock. So these are some examples of portfolios that someone may have. These are all assuming a long time frame, like retirement, based on how much risk someone is comfortable with. So someone that's super aggressive, that means, you know what? They don't care if they see their portfolio go down. In fact, they may want to buy more when things are down. They may have 75, 85% in stocks versus someone who's more conservative may only have 30 to 40%. Okay. Now, the downside of being more conservative is in the long run, you're probably going to earn a little bit less because stocks earn less in the long run typically, right? But you're going to have a smoother ride. So there is going to be that trade-off between risk and return. Now, the reason, by the way, that someone who's aggressive, even if you're an aggressive investor, is going to want to have something in bonds and cash is this idea of rebalancing. This is a really important concept because this is where a volatile market like we're seeing right now can actually help you. It can be a good thing. So here's the way it works. Let's suppose that you are, investing for retirement. So you got a long time until you need the money. And you decide to put 60% of your money in stocks, 30% in bonds, and 10% in cash. So that's kind of a typical moderate mix. Okay? Now, suppose that the stock market does really well, like it did last year. Last year, the market was up double digits, right? And now the stocks make up 70% of your portfolio simply because they went up more than the bonds and the cash did. Well, what you're going to do is what's called rebalancing. And when you rebalance, all you're going to do is bring yourself back to that 60% target. So it's kind of like, I hate to use the analogy of gambling, but let's just use it, right? If you were on a winning streak and you were kind of, making money in Vegas or whatnot, and you might want to take some of those winnings and pocket them, right? And that's the idea. When the stock market's doing well, when you rebalance and put that money in bonds and cash to bring yourself back to 60%, what you're doing is you're putting some of that money in the safer places. Not all of it, because we could have several good years in a row. Okay, we don't want to miss out on that. We don't want to take all our money off the table. But the higher it goes, the more we're going to take off the table. Because eventually, and I'm telling you right now, nobody knows when this will happen or why, but at some point the market's going to go through a decline. So this year, it was because of COVID-19, right? In previous years, we had a financial crisis in 2008. We had a war. We had a terrorist attack. We had the dot-com bubble. And you know what? We're going to have things in the future that nobody's going to predict. Nobody's going to be able to foresee. I tell people, when you invest, you have to do it fully knowing that it will go down. Not that it could, but knowing that it will. So you have to have a plan. So what is the plan? Well, let's suppose 60% of your money is in stocks. And because of this decline, now we only have 50% of our money in stocks. And by the way, as a coincidence, this is actually what would have happened to you earlier this year. If you did have 60% of your money in stocks, when the market went down, it actually would have fallen to about 50%. And this time, when we rebalance, we're going to move money out of the bonds and the cash into the stocks to bring ourselves back up to that 60%. So this way, the lower stocks go, the more you're buying. So if they go to like 40% or 30% of your portfolio, you're going to put even more money in to bring it back up to that 60%. Okay? And so just by doing this, and you only need to do this about once a year. So don't worry, you don't have to look at your portfolio every single day and say, oh, should I rebalance? In fact, it can be counterproductive. Just pick one time a year. It could be your birthday, it could be the beginning of the year, the end of the year, when you're going to look at your investments and rebalance them. And if you do that, you're going to be following Warren Buffett, probably the most successful investor alive today, what his advice was when he was asked, what is the secret to getting rich by investing? He said, the key thing is you want to be greedy when other people are fearful and be fearful when other people are greedy. In other words, when the stock market's doing great, you probably want to be taking a little bit off the table. And when it's doing horribly, that's when you want to be putting money in. You're not timing it. All you're doing is rebalancing, always coming back to the percentages that you set. Okay? And in fact, if you have a 401k plan at work, you might even be able to set it to automatically rebalance for you. So take a look and see if you have that feature in your company's retirement plan. So this shows you why this works. Now, I know this chart's a little hard to see, but these are from 2000 to 2019. These are different types of investments and what was the top performer at the top and the worst performer at the bottom. And you could see it cycles through. Sometimes you have something that's like the best one year and it's the worst the next year. Like look at 2007 as an example. The best performer that year was emerging markets. So that's countries like Brazil, Russia, India, China. And then in 2008, they were the worst performing investment. And sometimes you have things that do well for several years in a row. The point is these things are really hard to predict. So anyone who tells you that they know what's going to be the best thing in the following year, I would be very skeptical of that, because if someone was consistently able to predict this, they would have an amazing track record when it comes to investing. And we really just don't see anyone doing that, including all the professional investors out there. So the idea of diversification is by having some money in all of these different categories, you always have something that's doing well, and you always have something that's not doing so well. But that's okay, because the one that's doing well, you're going to take some of those gains off the table, and you're going to buy the thing that's not doing well. Because the thing that's not doing well today, at some point in the future, that dog will have its day. So all of that just happens automatically just by rebalancing. So you're not making any predictions or anything like that. So you don't have to worry about watching CNBC or reading the Wall Street Journal and trying to figure out, oh, what is the next hot thing? The reality is nobody knows. And it's much better to have a little bit of everything so you always have something doing well. Now, how do you actually do this? So this was like a brief, quick overview of the basic idea of how to, make sure you're diversified and take advantage of a downturn. But there are a lot of different ways of investing, and it all depends on how involved you want to be. Now, if you're someone who likes to research investments and you like to be very involved, some people like to pick their own stocks and bonds. This is kind of like, I'm going to use an airplane analogy for this whole thing. It's kind of like flying your own plane. Really, the main reason to do it is because you just enjoy doing it. But like flying your own plane, you better understand what you're doing to make sure you're properly diversified, and it is a lot riskier, okay? The advantage is you have full control. You can decide what you want to have. You don't have to pay management fees to anyone, but you really have to, again, have that time and expertise to make sure you're properly diversified. And that's why when most people invest, they don't do it through stocks and bonds, individual stocks and bonds. What they do is they buy mutual funds, right? A mutual fund is like flying commercial. You're pooling your money with other investors, just like when you get into a plane with other passengers, and the money manager of the fund is picking investments for you, just like the pilot is flying the plane. So the advantage here when you buy a fund is it diversifies the money for you. It's professionally managed. A lot of that is taking control. You lose a little bit of control, right, of what specifically that fund is investing in. But honestly, for a lot of people, not having that control is probably a good thing. And then you have a specific type of mutual fund called a premix fund. These funds make your life really easy because you only need one. So in one fund, there's a whole mix of investments. So an example of this that you probably have in your retirement plan at work is like a target date fund. And with a target date fund, all you got to do is pick the one with the year closest to when you think you're going to retire. So let's say I'm going to retire in 20 years, 2040. I can put all of my money into the 2040 target date fund, and it'll diversify for me, and it will rebalance automatically. And as it gets closer to retirement, so as my time frame gets shorter, it will gradually become more conservative, okay, as I'm getting closer to that retirement date. And that's why I say it can be as simple as just picking a target date fund, putting your money into it, set it, and forget it. Now, the final option is to work with an investment advisor. This to me is like having a private jet. You can have a lot of control because you can tell your advisor exactly how to manage your money. They can customize things for you. You don't have to work on someone else's schedule. It's a better experience. You get a much higher level of personalized service. But just like with a private jet, it's going to be a lot more expensive. The advisors do charge fees, and you want to be aware of the impact of those fees on your portfolio, especially if you don't realize you're paying a fee. You want to know what those fees are, right? So and I think where they can come in the most handy is when you have a lot of money in a taxable account. So that means money that's not in a 401k, not in an IRA, just like a regular account. And an advisor can really help you manage the taxes and help reduce taxes. But for most people that have all their money in a 401k and an IRA, as long as you're diversified, like with a target date fund, you may not need an advisor, and you can avoid having that fee. So if you're going to invest in mutual funds, how do you know which ones to pick? Well, typically what people will do is they'll look and see, well, which funds did the best in the past, right? Which ones had the best performance? That's the most common question people ask when they're looking at funds. Now, this is a study that Barron's does, and they do it like every year, where they look at different time periods and they say, okay, what were the top performing funds? Let's say over 5 years. And then they say, well, how well do those funds do over the next 5 years? Well, if you did it randomly, the chance of a particular fund being in the top 25% over a 5-year period is 25%, right? 25% chance that a fund will be in the top 25%. But it turns out when you look at these top funds, the chance of them staying in the top 25% was actually less than 25%. In other words, you would have been better off just closing your eyes, picking up a dart, and throwing it at a dartboard of mutual funds than you would have picking top performing funds in the past. So past performance, not only is it not a guarantee of future performance, it's a terrible indicator of future performance. So what is a good indicator of future performance? Well, studies have found repeatedly, Morningstar, in fact, has said that the #1 most proven, most reliable indicator of what funds are going to do well when you're comparing like to like is low cost. Basically, low cost funds over time do slightly better than ones with higher costs, basically by roughly about the same amount as the fee difference. So you can see here the difference between the ones with a high cost are the ones in that bluish greenish color, and the purple are the low cost funds. It was about a 1% difference. And that 1% is about the average extra fee that some mutual funds charge over the really inexpensive funds. In other words, what we find is that basically all these different funds on average do about the same. And the main difference is the fee. So some years, some funds will do better than others. It's kind of random. There's no way to really know which fund is going to do the best in any given year. When you average it all out, they end up all doing about the same minus the fee that they're charged. And so what are these fees? So here's some of the costs that you see that mutual funds have. There's what's called a front-end load. So this is a fee that you could pay to someone who's selling you a fund. Then there's the expense ratio. That's the biggest one of all. The expense ratio is the fee that that fund charges you for being in the fund. And then they charge you that every single year. And then every time the fund is buying and selling, it costs money. And that money comes out of your pocket. That's what's called the transaction costs. And that averages about 1.3% if the fund is trading a lot. And then if it's in a taxable account, you're also paying taxes. So all of those things add up. It can be, look at that, almost 5% if you have a really active fund. So if you want to minimize your costs, one way to do that is to pick what's called passive funds or index funds. An index fund is a fund that doesn't try to pick the best stocks or the best bonds. It just buys all the stocks in a particular, what they call an index. That's a way of dividing up different types of investments. So because of that, the fees are really low. And because the fund is not trading that much, it's not racking up all those transaction costs and taxes. And as a result of that, you can see that over the long term especially, and the more funds you have, this is the percent chance that the active funds would do better than index funds. And you could see that chance is really slim. So in other words, if you're going out there picking these active funds, let's say we're looking at a 20-year time period, there's between a 1% to 3% chance that those active funds are going to do better than passive funds. So it's possible, but statistically highly unlikely that you're going to find that very small percentage of funds that beat the passive funds. And by the way, the ones that do it in the past don't necessarily do it in the future. Okay, and this is why I'm going to show you a quick headline here. Warren Buffett actually made a bet a few years ago, and he bet $1 million. Okay, $1 million to charity that an index fund, so that's that simple passive fund, would do better than any hedge fund. And the hedge funds are supposed to be the best of the best of the best in terms of money managers. And only one hedge fund took him up on it. And this bet ended, gosh, it was pretty recent. It was like a year or two ago. And it wasn't even close. That simple, passive, low-cost index fund did better than the fancy schmancy hedge fund. And we've seen this again and again and again in academic studies. And so that's just one more thing I want to leave you with. So if you're trying to pick funds, make sure you're aware of the costs. Okay, so what can you do in a down market? The first thing to do is evaluate portfolio. Make sure you're properly diversified. And the simplest way to do that is you can do something like picking a target date fund. That's how simple it can be. There are also, if you want to have a little more choice and options, there are other ways to do it. There are model portfolios out there that you can choose. There are apps out there, like you might have heard of Betterment and Wealthfront, that will design a portfolio for you. But let me tell you the truth about this. It almost doesn't matter which one you pick. There's no actual evidence that we have any idea which portfolio is going to do better in the future. Okay. The key thing is you have something that's reasonable, a reasonably diversified portfolio, and that it matches your time frame and how comfortable you are with risk. Okay, that's the key thing. And so if you use those apps, they'll ask you questions to help you figure out, your time frame and your risk. If you use a target date fund, it's going to do that purely based on your time frame. If you want to be a little more aggressive, you can pick a later year. If you want to be a little more conservative, you can pick an earlier year. And by the way, if you don't believe me that it doesn't really matter which portfolio you pick, I want to show you one other little thing here. Where is this? I'm going to come back here. And this is a blog that I really like. This guy named Meb Faber, who's an investment manager. What he does is he looked over 40 years at all of these portfolios that you see here on your screen. And these are all portfolios designed by various investment experts that you might have heard of. And a lot of them are featured in books, some best-selling books. Lots of big name people here. And what he found is when he looked at all these different expert portfolios over this 40-year time period, the difference between the absolute best portfolio, which over this time period ended up being, let's see, earned 10.49%, William Bernstein's portfolio. And what was the absolute worst was the permanent portfolio at 8.88. So you're talking about less than 2 percentage points. Okay, most of them were within 1 percentage point difference over that time period. So if you just paid a 1% fee, you could have had the best performing portfolio and turned it into like the worst performing portfolio. So really the point is, it doesn't even matter which one you pick, whether you're going with something an advisor puts together for you or a model portfolio or a target date fund. You just want something that's reasonable and you can stick with it. And then make sure that your costs are as low as you can, because the costs are really going to make a difference. The second thing is rebalance. If you haven't done that, like I remember I said, just once a year, rebalance to make sure you have your right percentages. If you have a target date fund, it'll do it for you. For those of you who are thinking about potentially converting money into a Roth, that's where you have an IRA, or sometimes you can do it in your 401k, and you could pay taxes on the money now. And then what happens is that money can then grow to be tax-free. A downturn could be a good time to do that, because while the market's down, that could be a good time to pay taxes on it. And then when it comes back up, all that money can grow to be tax-free. And another final thing I'll mention is this idea of tax loss harvesting. What that means is if you have money that's outside of a retirement plan, like that's not in a 401k, not in an IRA, and you have some losses, you can sell those investments, use those losses to offset other taxes, and then you can just reinvest that money. You just have to do it in something different, or you have to wait past 60 days if you want to reinvest back into the same investment that you sold. So that I know gets a little complicated, and that's why I said a financial advisor can sometimes be helpful. But for most people, don't really have a lot of investments outside their 401k and IRAs, and so that really may not even apply to you. But I just want to point those last 2 points out, for those of you who are looking for a little bit more of an advanced tax strategies. And I can talk more about that if you like in the Q&A. Last thing I want to end here with is some good news, which is that if you look at previous downturns, this is someone who started investing at the very worst time. So if you had started investing in the stock market right before the crash, but you just kept putting in $1,000, this is how long it would have taken you to make your money back. And you could see that the worst case, even in the Great Depression, you would have made your money back in 7 years. And that, is a pretty bad scenario. So, there is a light at the tunnel. We will get through this. I know actually the market's been doing recovering a lot lately, but I do want to point this out because we could go through another decline. And I just want you not to panic. Remember, if you have a long-term time frame, you should be fine with your investments, as long as, again, you are diversified. Okay, because if you only have one stock, that one stock can go to zero and never come back. But as long as you're diversified, historically, you would have been okay. All right. Now, I know we covered a lot of different things there. Some of it I realized was very basic, but I wanted to really emphasize that because I really think sometimes, even if you consider yourself an advanced investor, a lot of times we get caught up in things that are really impossible to predict and can really hurt you in trying to chase returns or trying to predict what the market's going to do. Sometimes it's good to just, remember the basics of being reasonably diversified, keeping your costs low, and sticking with your plan through thick and thin. And with that, what I want to do now is really kind of open it up for questions on anything either that I talked about or maybe something I didn't get a chance to cover.
Awesome. Well, thank you so much, Erik. I know that was really informative and beneficial. I certainly took some notes, so I'm sure everyone else did as well. So what we'll go ahead and do is start with questions that were submitted during registration, and then we'll go ahead and answer some questions that were submitted through the chat. So a friendly reminder again, if you have any other questions that pop up, whether it's super specific or not, feel free to go ahead and ask your question, and we'll hopefully get to it at the end. So Erik, we're going to go ahead and first start with, you mentioned a little bit, but if you can do kind of a step-by-step, what steps to take as a first-time investor?
So if you're a first-time investor and you want to keep things simple, I would say the best way to do that, chances are if you're a first-time investor, it's probably because you have a 401k plan or something similar at work and you're trying to decide what to invest in. Easy way to do it is to start with a target date fund if that's available in your plan. And chances are it probably is. And you can just pick the one with a year that's closest to when you think you're going to retire. So maybe around the time you can turn, say, 65 or something like that. And that's, it's a very easy way to do it, but studies have found that people that try to pick their own investments do worse than just picking a simple target date fund.
Awesome, thank you. Can you give any tips on a Roth 401k?
So I think a Roth 401k can be a good option for someone who thinks that their tax rates are going to be higher in retirement than they are now. Because with a Roth, you're paying the taxes now, but as long as you've had the account at least 5 years and you're over 59 and a half, all the earnings in a Roth account are tax-free. So you're paying the tax now instead of later. So if you think your tax rate might be higher or you're worried about tax rates going up, those are good reasons to have a Roth. Also, I just want to throw this in there. If you think you might want to retire early, let's say, especially before 65, but even earlier, there are also advantages to having money in a Roth. Just real quick, because 65, of course, is when you're eligible for Medicare. And if you want to buy health insurance through the Affordable Care Act, the subsidies are based on your taxable income. So if you have tax-free money coming from a Roth account, it's not going to count against you when they're deciding those subsidies. So if you think you might retire before 65, you may want to have at least some money in a Roth.
Awesome. What is a good benchmark for amount saved if you were to break it down by age group? So for 20s, 30s, 40s, 50s?
So, I would not actually think about it in terms of a certain benchmark. I know you've seen things out there, but the best way to do it is to actually do a calculation based on how much income you want to have in retirement. And also your situation. Like some people, you may be fortunate to have a job that still has an old-fashioned pension plan, right? You may have a mortgage that will get paid off where you don't need as much income. So you really want to think about, okay, well, what do I have today? How much am I saving? And if I continue to save that amount and my money continues to grow, I like to just be conservative, a 5 or 6% return. Is that going to give me enough money to live the lifestyle I want? And a good rule of thumb there is whatever amount of money you're going to have in retirement, you can generally expect to get 4% of that every year for income and then grow that with inflation. So for example, if you have $1 million in retirement, that's the equivalent of like $40,000 a year. So it is a little calculation that you can do. And there are a lot of, even if you just Google it, a lot of retirement calculators to figure out. But I would not look at these benchmarks because it is not based on you. And everyone's situation is so different.
Great, thank you. Let's see, we have one more. I know you mentioned a couple of apps that people can use for investing. Can you remind us what those were?
So some of the most popular ones are Betterment and Wealthfront. Be aware that the good news is they do use those low-cost index funds, but they do charge an extra fee. It's a small fee, but there is an extra fee that they charge to make that interface. So you can basically have a very similar portfolio without the app and avoid the fee. But if you really like using the app, it's certainly a lot cheaper than using an investment advisor.
Okay, and then last one. Yeah, last one from registration, and then we'll go ahead and hop into the chat, is as a retiree, where is the best place to put one's investments with interest rates so low?
I wouldn't say it's any different. I think a retiree is going to want to have a diversified portfolio like everyone else. They're probably going to have one that's more conservative because they have a shorter time frame. So I think a misconception is the idea that retirees should put everything in interest, like bonds and cash. And the problem with that is it's not going to keep pace with inflation. So even if you get enough income, which is very hard to do right now with interest rates so low, just from interest, remember your expenses in retirement are going to keep going up. And if your income is not going up, then that's going to be a problem. And that's why you still need to have some money in stocks to get some growth.
Great. Alrighty, well, that's it from registration or questions submitted during registrations. We're going to go ahead and answer some of the questions from the chat. And we still have a couple more minutes, so if you have more, let us know. So Erik, can you see the chat?
Yes.
Would you like me to ask you, or would you like to go ahead and answer the questions based off of your preference?
I'll just go ahead and answer the questions. So the first one is, what is the best stock to bond to cash ratio for post-age 65 retirees? There is no one right ratio. What studies have found is that anywhere between 50 to 75% of your money in stocks gives you the least chance of running out of money in retirement if you are pulling, let's say, a 4% income from your nest egg. So if you're more of a conservative investor, maybe you want to keep about 50% of your money in stocks and the other 50% in bonds and cash. And if you're more aggressive, you may want to go as high as 75%. And if you're in between, you may go 60%, which is what most pension funds use. And that's considered a kind of moderate portfolio. Next question is, why is the assumption that the tech sector will come back down / slow down? Well, the reason that there is that assumption is, if you think about it, if any sector, it doesn't matter what it is, continues to grow much faster than the rest of the economy, and then it's becoming a larger and larger percentage of the overall economy, and eventually it will become the entire economy. Now, is that impossible? No, it's not impossible. It could happen. I would say it's probably highly unlikely. And we've seen in the past, there's all these different time periods where there was a hot sector or a particular group of companies that were doing really well. And eventually, it was what they call regression to the mean, right? They came back, to a more normal growth rate. That doesn't mean it's going to happen anytime soon. We could continue to see the tech sector outperform for a long time, but I would certainly not put all of my money, or even most of it, in any sector, including the tech sector. Another question is, should a recent grad start investing or concentrate on paying off student loans? Great question. So here's what I would do. And this applies to all forms of debt. If the interest rate on your student loans or on any other debt is above 6%, you're probably better off paying that debt down, because you cannot expect your investments to earn more than what that debt is costing you. Your investments may earn more, but you certainly can't expect it. On the other hand, if the interest rates are below 4%, like a lot of mortgages right now, or like 3% or even less, then you're probably better off not paying down the debt. That's why they call it good debt. And instead, if you have extra money, you'll probably earn more by investing that money. Now, if the interest rate is between 4 to 6, which is where a lot of student loans are, I would say it's personal preference. If you're more conservative, maybe pay down the debt. Because if you're a conservative investor, you'll probably be happier paying off the student loans, and your investments probably won't earn as much in the long run. If you're more of an aggressive investor, you're probably better off investing. You'll be happier, and your investments will probably have a higher, at least, likelihood of earning more than what those student loans are costing you. Next question. If investing in 100% stocks over a 20-year period is always a winning investment, doesn't it make sense for anyone less than 45 years old to keep his or her portfolio in 100% stocks? Assume someone plans to retire at 65. All right, great question. So several pieces to that. Number one, we don't know for sure that it's always going to be a winning strategy. We just know that over that time period, there was never a 20-year period where it was negative, right? But it's not a guarantee. So that's one thing. But having said that, yeah, I mean, there is an argument, I think, for someone who has a long time frame to have, if they want to have 100% in stock, they're not going to be able to benefit from that rebalancing. So there is an argument to keep some money on the sidelines, even if you're aggressive, so that when the market goes down, you can rebalance and buy more of the market when you have a downturn. So it might be better to have like 80 or 90% in stock, just so you have something that's on the sidelines. The other thing too is that you also have to factor in risk tolerance. The thing about having 100% in stocks is you're going to have times where you're going to lose like almost half your money, because there have been periods where the stock market pretty much lost half its value. And if you can't hold on, you may be tempted to sell, and then you're going to miss the recovery. So you also have to be honest with yourself of, how much of that volatility you can really take, because most people are not able to hold on to something that's that volatile. And so that's where something a little bit more moderate, even if you have a long time frame, can be a good idea. Question, where would it be a good place to learn about how to invest in the stock market? Lots of good resources. Actually, what I would put forward is actually, I think this was the blog that I was just showing. So not just the blog, but Meb Faber has actually written a book called Global Asset Allocation, which I think is pretty good because it really, what's neat about this book and the reason why I like it so much, Global Asset Allocation by Meb Faber, that's his name, is because he actually looks at all the other books that have been written about investing, and like each chapter covers one of the different strategies that other books talk about. And then he basically does what you see in this blog post. He compares them and he finds that in the long run, they're not that different, right? So I'm already giving you the punchline if you want to skip, reading the book. But if you want to dig into the details of it, I think that's a good book to really look at. Are there more opportunities, is the question, to invest in companies focused on sustainability, alternative energy to gas, etc.? So here's the interesting thing about trying to figure out investment opportunities. And I'm not saying it's a bad question, because actually it's a great question, but if you're thinking about those opportunities, you can bet that investment managers and investment analysts are thinking about the same opportunities. And this is why it's hard to beat the stock market. Because the only way to beat the stock market is you have to know more than everyone else that's investing. Because the current prices are basically a consensus, right, of all the different investors out there in terms of what they think the best prices are. And you have to get it right more than everyone else does. And that's really hard. Even the professionals usually do not do better than the market. So there are a lot of funds out there that are trying to take advantage of exactly the kind of opportunities you're talking about. They're focusing on sustainability, alternative energy, and you know what? The data shows in the long run, it doesn't necessarily do any better or any worse than something that is more passive, that's just trying to buy everything. That being said, because it's not necessarily going to do worse, if you want to buy things like that for social reasons, right? If you want to stick to companies that are sustainable and you feel are environmentally, socially responsible, you can certainly do that. You're not going to suffer for it. Your portfolio will be a little less diversified because it won't include all the non-sustainable or polluting companies, but you probably won't suffer too much. You'll probably end up doing about the same. There are going to be some years you'll do better, some years you'll do worse, just like all these other investment strategies. And in the long run, it'll probably end up being about the same return. Question, what are some good index funds? I think what you want to look for are things that, well, first let me take a step back. Almost all index funds are good index funds because they're all basically the same. They're all going to invest in very similar things and have very low cost. I think if you're trying to figure it out, a good place to go is Vanguard. they practically invented the index fund, and they are owned by their shareholders. So they're basically nonprofit. So their fees are very low. But you know what? Fidelity has great index funds. Schwab has great index funds. The good thing about index funds is you can find them just about everywhere. And there's not that much of a difference between them. Question, what percentage of your income should you put in your Roth monthly? You know what? That's one of those things that you're really going to want to probably, I hate to say it, you're going to have to run a calculation is the best way to do it, to figure out how much you need to save to have enough money to generate the income you want to, is really the best way. You know, you hear these rules of thumb, like people say 10 to 15% of your income. So if you just want to start there, I think that's better than nothing. But ideally, I do think you want to run that, that calculation because it's so different for different people. Question, I missed part of the meeting, but I didn't hear you touch on real estate as an investment outside of REITs. I've heard the stock market outperforms real estate in the long run, but it's still good to invest in real estate. Okay, this is a great question. Real estate, if you're not talking about REITs, if you're talking about actually owning physical properties, is a completely different type of investment. I do it myself. I own 5 rental properties. And the best way to think about it, it's almost like starting your own business. And it's really hard to estimate what returns are going to be because the returns on specific properties vary so much. And a lot of it depends on the property you buy, how well it's managed. Just like if you're going to start a business, it's hard to know how much that business may make. Versus with the stock market, we can see, because if you're diversified, we can have a good idea of what it's probably going to do in the long run. So here's the deal with real estate. If you just compare the growth rate of real estate to stocks, it's true. Stocks have a higher average return than real estate. Believe it or not, real estate only earns slightly more than inflation in the long run, versus stocks generally earn 7 percentage points more than inflation in the long run. However, here is why real estate can be a great investment. It's because of leverage, okay? And what I mean by leverage is when you purchase a mortgage to buy a real estate property, let me just to make the math simple. Let's suppose that you buy $100,000 home and you put down $10,000, okay? Just trying to make simple math. Let's suppose that $100,000 property just goes up 3% with inflation. Not a lot, just 3%. Now it's worth $103,000, right? Well, you only put in 10 because you borrowed the other 90, but you just made 3. So $3,000 that you made as a percentage of the money you put in is like 30% return on your $10,000. That's why real estate is so profitable, because you are investing with other people's money. But it also makes it a lot more risky, because even if you buy an individual stock, the worst thing that can happen is it goes to 0. That's the worst thing. You lose everything. With real estate, you can lose more than you put in, because if you borrowed money and that real estate property falls below what you bought it for, you could end up negative. You could end up owing the bank more than it's worth. Not to mention, if your tenants stop paying the rent, you're still liable for paying the mortgage. If there are repairs that need to be made, you may have to cough up more money to put into that real estate investment. So to me, I look at real estate as a high risk, high return investment. High risk because it can cost you more than you put in, high return because of that leverage. So it's just a very different beast than the stock market. I'm not saying it's better or worse, it's just very different. Okay, I think we got all the questions in the chat, but if anyone else has any more, definitely feel free to submit them.
Alrighty, everyone, you still have a couple of minutes, but I wanted to hop back in and say thank you to Erik for your time. We have about 4 minutes left. If anyone would like to hop on and submit more questions, feel free. But I wanted to say thank you to Erik. Thank you to the New York Torero Club for putting together this event. And thank you, Erik, for your participation on that committee as well. Before we go, I wanted to let you all know that Erik said that we can provide his contact information in the thank you email for the event. So please look out for that from me tomorrow. You can follow up with questions for Erik. And then also, I wanted to make sure that you all knew the different resources you can access as alumni of the University of San Diego. So please, if you have the time and availability and need the resources, visit the USD Alumni Association website at alumni.sandiego.edu. To be more involved with either the New York Torero Club or other Torero clubs that fall under our 22 regional Torero clubs, please feel free to visit the Communities tab and get connected with fellow Toreros in your area. So let's see, did anyone, any last minute questions? No, just a lot of thank yous. So again, oh, there's one more. Thank you for all who joined us. If you'd like to hop off, feel free. And then Erik, if you can answer that one last question, that'd be great.
Okay, question is, so for real estate, do you recommend to not fully pay the property to take advantage of that leverage? I can tell you that that's what I did, because that's a lot of how I see the value of investing in real estate, is taking advantage of that leverage. And then someone just said that they agree, they own some properties, has been a great diversification. Yeah, real estate is a very, it's a good way to diversify, but it's not something everyone needs to do, and it's probably not something everyone should do.
Awesome. Well, great, everyone. Thank you so much for joining us today. We hope we'll see you again. If you'd like to see more events like this and would like to log on, please let me know. Any feedback is great feedback. And once again, thank you to Erik for your time today. It was wonderful. Great.
Thank you. This is fun.
All righty. Have a great rest of your day, everyone. We hope to see you guys again soon. Bye.
Bye-bye.